Okay. Yeah, hi everyone, and welcome to another session of Moneyfy Mantra, a webinar series where we talk to various industry experts about various aspects of personal finance, and we talk about various investment products. And I am Gaurav, your host for today's session. And just to quickly introduce Moneyfy app for people who have joined for the first time, Tata Capital Moneyfy is a complete investment app, and it enables our customers to plan all their investment insurance and financing needs in one single app. And we have some of the very interesting products in addition to mutual funds like corporate fixed deposits. We have also introduced NPS for long-term investment planning. Recently, we also introduced direct equity investment through small case. So please download our app and start your investment journey with Moneyfy. And in our last webinar, we spoke about tax optimization and planning since we are in the last quarter of the financial year. And today we are again going to talk about an important category, a very popular category, which is hybrid funds. And to talk on the same, we have with us Mr. Srivatsa. Mr. Srivatsa is an Executive Vice President and Fund Manager Equity at UTI AMC. He's a BCom graduate, CWA, and has a PGDM from IIM Indore. And he has been with UTI since 2002 and has got a very rich experience in the fund management and equity markets. So we will discuss on hybrid funds with him on this. So Mr. Srivatsa, a very warm welcome to you on Moneyfy Mantra, and it's our pleasure to have you here.
Yeah, thanks a lot, Gaurav, for the kind introduction, and welcome everybody to the Moneyfy Mantra. And I'm privileged to, and it's my privilege to give a kind of a short overview of the hybrid category. I think which is a very important category, and it always has its relevance in terms of market volatility. So I'll talk more on the category as well as the product offering that we have. So, UTI as a fund house has a big basket of products catering to the hybrid category, giving different solutions such as retirement or children or even a ULIP. And of course, I'll talk more on the hybrid fund which I manage. But we have an entire gamut of products catering to the hybrid category to cater to all the needs of the investor. So with your permission, I'll just start with a brief presentation.
Sure.
And then we can take it forward.
Yeah. At the same time, I would just request our viewers, if they have any queries, to post them in the chat window, and we will take up these towards the end of the session. So over to you, Mr. Srivatsa.
Yeah, just a second.
Sure. You are on mute, sir. You can unmute.
I think, Gaurav, I'm having some problem here because it is saying it's not allowing me to speak while sharing. Hello.
So you want me to present?
Yeah, can you just upload the file, because there appears to be some problem in my system that it's not allowing me to, it is putting me on unmute if I'm trying to share.
Okay. Sure. Just give me 1 second. I've shared.
Yeah, thanks a lot, Gaurav, and sorry for this brief interruption. So I'll just start with one of the flagship products that we have, which is the UTI Hybrid Equity Fund, which is essentially a aggressive hybrid equity fund as per the SEBI classification. I'll talk more about this as we come to the product suite that UTI has. So if you could just go to the next slide. So if you look at basically a hybrid equity fund is essentially a combination of debt and equity in various combination. I mean, we have an aggressive, which is essentially a 75-25. You have a conservative, which is a 25 equity and a 75 debt. You also have a 50-50 or a 60-40. So depending on the needs of the investor, we have various kind of options, and obviously each comes with its own set of risks and rewards. So a 75 equity and a 25 debt, which is essentially the product that I manage, which is an aggressive hybrid equity fund, will probably have a far higher risk profile than one with, say, a 25 equity and a 75 debt, which is a UTI regular savings fund, which my colleagues manage. So we have different kind of products in this entire suite, but the ultimate idea is to give the best of both worlds. And one has to appreciate, I mean, all of us would be aware that both these asset classes have very different risk profiles as well as return profiles, and a lot of times they are counter cyclical. So it kind of gives the best of both worlds depending on what the investor would want. So essentially, I think it kind of caters to a longer term wealth creation. So if you look at a 10-year, 15-year, 20-year track record, I think the risk reward or the risk adjusted returns of an hybrid fund, whether it is aggressive or conservative, would probably be in line with an equity fund. The second, I think, important part is the big challenge for all of us. I'm sure all of us who are into investments, is that there is a very big transaction cost of doing an asset allocation. Like, today, for example, both equity and debt both has taxation. So if I invest in equity today and after a year I want to shift to debt, I want to shift, say, half of my equity allocation towards debt, then I end up paying a tax on whatever gains I have made. And over and above that, there is a switching cost. So there could be some liquidity cost, there could be some exit load which I need to pay, and there could also be some timing cost because I may get the money today, but I may deploy it after a week, in which case I might lose out on some opportunities. So individually, if all of us try to do an asset allocation, it has its own kind of transaction cost. The advantage in a fund is, if you were to put it in a fund, there is an automatic asset allocation which happens. Like for example, if today in the UTI hybrid equity, equity is capped at 75% and debt is 25. Now, if equity were to go up by 20% in the next 1 year, and debt were to give, say, 3-4% returns, which is essentially what has happened in the last 1 year, obviously the weightage of equity would go to 80. But we automatically kind of rebalance it, sell off that 5-6% and move into debt. Now, if we try to do it ourselves, if we try to put up a product investing in a debt fund and an equity fund in the same proportion, the challenge is, again, there is a transaction cost, and there is a kind of a inconvenience because you will have to do it every month, every 2 months. And here this fund is automatically programmed to do it in terms of this reallocation. So coming back to the next slide, I think clearly the longer term history has shown, I mean, there has been a lot of studies which have shown that over a longer term time frame, I think asset allocation has been the biggest source or driver of investment returns. Yes, stock selection and market timing has been there, but if you look at an history of 40 to 50 years, it's been asset allocation which has been a very big source of investment returns. And as I said, I think it kind of mitigates the risk because there is an automatic asset allocation mechanism. It brings in diversification because you have different asset classes. And largely, I think there's no need of market timing here. I mean, whenever the limit gets hit or gets breached, there is an automatic, kind of a program which is enabled and which enables us to kind of adjust. Like, for example, in March 2020, the allocation had gone below 65%, but we immediately kind of moved money from debt and moved to 65 to 75 at the bottom of the cycle in March 2020. So, this kind of gives a very kind of a huge flexibility, or this ensures that this fund has a better risk return profile than a pure equity fund. Next one. Again, if you look at the equity versus debt, I think one thing which is very clearly visible here is the fact that it's always counter-cyclical. So whenever the equity performs badly, I think debt kind of makes up for it. And obviously, when equity performs very well, I think debt uh, performance is a kind of a little muted. So, which is in a way good for the profile of the fund, because when one performs, I think the other one doesn't perform. It kind of makes up for it. It's kind of a teamwork, where in a cricket team, if you can't expect all 11 players to fire, even if 4 5 people fire, I think that's good enough for the team to win. The next one. I think this chart clearly shows. So if you look at the history, I think whenever the equity markets have fallen, have had a big drawdown, say for example in 2011 or even in 2015 or 2013, I think the debt markets have kind of helped to kind of soften it. And whenever the debt markets have done well, we are essentially taking a 10-year GSEC as a proxy. I think whenever the debt markets have done well, for example, in 2016, we saw a very sharp rally in the G6. I think the equity market performance was muted. So if you look at over the last 10 years, I think these are kind of counter-cyclical, and it helps in giving better stability to the fund. Next one. I think what we have done is we have shown data constructing a Nifty 50 index as well as a Nifty 10-year, and then a hybrid of Nifty 50 with a composite debt of 65-35, which is essentially the hybrid fund index. And this itself shows that obviously in a period of good time, the returns are less than what a Nifty 50 would give. But if you look at on a 3 year and a 5 year time period, I think the returns are quite closer to where Nifty 50 is. And if you look at a year where there has been a drawdown on the Nifty, I think the returns have been far superior. So this clearly, I think, shows the benefit of an asset allocation in terms of getting an equity like return with a far better risk allocation, or a risk metric than a equity oriented fund. Next one. So coming to what UTI has to offer, I think we offer products across the spectrum. So starting with the least risky, which is an arbitrage fund, which essentially is a proxy for a liquid fund. I think we kind of deal in arbitrage between the cash and the futures market. So your returns are capped at 4 to 5%, but then you kind of get a return profile very similar to a liquid fund. Then we have what I call as a regular savings fund, which is a 25% equity and a 75% debt. Again, this is a very conservative fund, which ideally should be taken up by the first time equity investors. The second is equity savings fund, which is again a very similar construct to the equity regular savings. The only difference being that 40% of the portfolio is invested, 30% of the portfolio is invested in the arbitrage as against debt. Otherwise, the construct is very similar to the regular savings fund. Then we have specific solution-oriented funds such as ULIP, Children Savings Funds, and RBP, which is a fixed allocation of 60-40. And these are specific solution-oriented goals. Like, for example, we have a unique children product. We have CCP savings. We also have a ULIP, which is a vintage fund. I mean, it has crossed 50 years now almost. We have already crossed 50 years in this product, probably the only mutual fund to have crossed 50 years in India. We also have the RBP, which I manage, which is a retirement benefit fund, which is essentially designed to give you an income after retirement. And we also have what we call a multi-asset fund, which is essentially a combination of equity, debt, as well as gold. And finally, we have a hybrid equity fund where we have where the equity part is the highest, 75-25. We also have a CCP investment. Now, this is part of the CCP, the Children's Investment Fund. As in, we have two options for a children investment. One is 100% equity, and the other one is a balanced of 60-40. So essentially, I think you can kind of balance out your children's investment, putting into these two funds, and ensuring a better corpus for your child, whenever your child needs it at the time of his education. So in terms of having a basket of products on the hybrid side, I think we have every possible solution that the investor would want for his asset allocation funds. Next one. Coming to the equity part, so essentially, this is a kind of a quasi-equity fund. So since equity is around 75%, so just to give a background on the equity part, I essentially manage equity with a value kind of a tilt or a value philosophy, where I look at the entire value from three parameters. One is obviously the core one is a valuation, buying good quality stocks at below historical averages and looking at relative value as a very key metric. The second important the criteria we have is that all our companies should have a return of capital higher than the cost of capital, at least in the future, over the foreseeable future. And the third is fundamentally sound business. So where we lay a great deal of importance on both corporate governance as well as the business being very fundamental. So the core philosophy of the fund is having a disciplined approach which attempts to benefit from the fluctuation in the valuation cycle of stocks. So what we believe is the any good quality stocks has its own kind of valuation cycle depending on the environment it is in or the external environment it is in. And there are a huge amount of arbitrage which happens. I mean, we may have seen a lot of stocks like, for example, Infosys 3 years back was quoting at 15 p. Today it is quoting at 25 p. Our aim is to benefit from the differentiation in the valuation cycles to buy good quality stocks at the lower end of the valuation and at the same time exit at the higher end of the valuation to benefit from that. Next one. In terms of, I think in any value strategy, what is very important is the exclusion filter, because typically most of us get it wrong in having a higher share of value traps. So the kind of filters that we have for companies are, one is poor operating cash flows or weak ROCE through a cycle. However cheap it is, we don't take it in our portfolio. And for the fund house as a whole, governance is a very key metric that we look at, and that's something that we focus on. And we also typically tend to avoid high leverage companies in the portfolio, as well as we also typically tend to avoid mature businesses, like for example, a coal business or a print business where there is an expectation of a limited terminal value there. And again, we also tend to avoid high PE stocks in the portfolio. So we do believe that valuation of 50-60 PE is unsustainable in the longer run, and we typically tend to avoid that in the portfolio. Next one. In terms of investment strategy, as I said, the core is looking at the relative valuation in good quality companies, which provides a very good margin of safety. The second one is like we have a decent 30% allocation to mid and small caps, where we focus on growth opportunities, because we believe that those mid and small caps may not be very well covered by the market, and because of our very strong in-house research, we would be able to identify those opportunities, and that's been the focus on that. The third is also focus on cyclical companies, where preferably I think we focus on leaders there, where the cycle is adverse, and we kind of expect to benefit from the mean reversion. So just to give an example, 2 years back, I think we went overweight on metals because we believed that the cycles were in favor. The steel prices were at the lowest levels, and the valuations were very attractive. And that kind of helped us outperform in the last couple of years because we were overweight at the right time. So the emphasis is on getting the stock at the right valuation and focusing on good quality companies across the three streams that I talked about. The next one. So in terms of strategy, as I said, we evaluate businesses based on their ability to generate ROCs greater than the cost of capital. That's, as a fund house, we have an excessive focus on this. So it doesn't matter that if in the current year the business is not able to generate ROCs, but we do want to ensure that our investment thesis is based on a future ROCs greater than the cost of capital. And typically for this strategy, margin of safety is very important in terms of us buying the stock at the right valuation. And also in terms of focusing on cash flow, leverage, and growth. I think cash flow is again a very big metric that we track internally, and typically we tend to avoid companies with poor cash flows. And consequent to that, even leverage is something that we tend to avoid. We do buy companies with leverage, but excessive leverage or very high leverage is something that we would tend to avoid. In terms of stock selection, we have both top-down and bottom-up kind of a stock selection. And typically, we certainly look at sectors as well, which trade below their mean valuations, and as well as stocks. And generally, mid and small cap stocks, we buy it more on the case of bottom-up kind of a stock selection. In terms of valuation metrics, I think one thing I'll show the data as well is that the PE and the ROE of the portfolio is significantly lower than the benchmark index as well as a peer. So one of the kind of a key criteria to identify a value fund is to see whether the valuations of the fund in terms of price to earnings or the ROE is significantly lower than the benchmark or the peer group. I think that would give you a fair indication what is a value fund and what is not, and this definitely meets that criteria. Next one. So in terms of our framework, as I said, we have a relative value style, so preference for stocks trading cheaper. We have a blended approach, which I shared, of both top down and bottom up. uh, Typically for this strategy we have around 70% allocated to large cap depending on the cycle. As of now we have 70% allocated to the large cap. We have around 20 to 30% allocated to the mid and small cap, so roughly 20% is mid cap and 10% is small cap. And again, in terms of limits, we have a single sector not more than 35% of the equity part, or benchmark plus 12. Single stock is capped at 9.5, and top 10 is capped at 55%. In terms of portfolio churn, I think the churn is moderate given the fact that we follow a value style. So typically, I think today you may have the banking sector in value. 1 year down the line, you may have IT sector in value. So over a period of time, the sectors in the value zone keeps on changing, and there is a need for us to kind of move in, move out over a period of time, which is why the churn ratio is higher than probably at least some of the UTI funds, because as a fund house, our churn ratios are far lower than the industry. In terms of a snapshot, I think the equity allocation, it is capped at, as per the SEBI regulation, it is capped at 80%, but internally we have capped it at around 75%. So we rarely go above 75%. Right now it's about 73, 74, but even though SEBI allows us to go up to 80, we have an internal cap at 75. The reason being that, we are following a slightly higher risk strategy in terms of having a 30% allocation to mid and small caps. To counter that, we are having a lower allocation than what is being allowed by the regulations. In terms of debt, while the maximum is 35, but again, it's capped at 21, 22, simply because the equity is at 75. And we also have a flexibility to invest in REITs and InvITs to the extent of 10% of the portfolio. We have just done one investment in a REIT till now. But again, our aim is to take it to 5% as and when more and more opportunities arise. And the fund size is fairly big at around 4,000 odd crores. And this fund has been in existence for a fairly long period of time, since 1995. And I've been managing this fund since 2011. Again, the point that I shared is to see, what are the valuation trends vis-a-vis the benchmark. So if I look at the price to book, it is significantly lower. If I look at the price to earning, it is significantly lower. And even the return of equity, I think it's lower, but my expectation is that over a period of time, the return of equity would be higher than what is being shown here. And in terms of the risk metrics, the top 5, top 10 is far lower than the benchmark. And again, the beta is slightly higher, largely because of the fact that we have a kind of a 30% exposure to mid and small cap, and the risk metrics also looks kind of fine. And as I said, our market capitalization is roughly around 70% large cap, and mid cap is about 16, and small cap is around 13. Yeah, next one. So in terms of maybe you could cover the next one. I'll talk more on the sector part. So in terms of a key overweights, I think today we are quite positive on the financial services. So our overall theme on the equity today is that we are extremely positive on the domestic growth. We do believe that the last 2 3 years has been a challenging time as far as growth is concerned, and we believe that the next 2 years would be a very strong period of growth. And to that extent, we have overweight position in financial services, automobile, as well as construction, which is largely real estate and infrastructure led sectors, as well as pharma, where a significant part of our holdings actually cater to the domestic pharma and telecom. So I think this fund has a very distinct kind of a twist or profile towards sectors which are likely to benefit from the domestic growth. And at the same time, we are underweight on sectors exposed to the global growth, which is essentially information technology, oil and gas, because that's largely commodity, as well as metals. Power, we are underweight because of the valuation part, because of our discipline on valuation, we are underweight on power, and consumer goods also the same. While the stock has corrected, or rather, there has been a time correction in the last couple of years, but clearly, I think the valuations have not come to a comfort level. In terms of our overweight stocks, I think we believe having an high active weight. So our active weight is around 65 to 70%. And generally, I think it's concentrated on the larger caps. So if you look at the portfolio, these are all deep value ideas, which we have taken. And some of them have worked, some of them are yet to work. But that's the kind of philosophy, we believe in. At the same time, if you look at the underweight, I think most of the stocks are what you would classify as expensive, and in true line with our philosophy, we have gone underweight on them. In terms of the portfolio changes, like I think the last 3 months, we have made more and more increase towards the domestic cyclicals, whether it's financial services, automobiles, or real estate, as well as telecom. As I said, I think I'm quite sanguine on the prospects of domestic recovery in the next 2 3 years, and I do believe that the domestic-oriented sectors are undervalued with regards to this cyclical recovery, which will happen over the next couple of years. And at the same time, I think I do believe that with the rise in the US rates and inflation pressures, global growth may take a backseat, and sectors which are exposed to global economies may underperform. So we did have an overweight position on IT and metal 6 months back. We moved that to banking, and we moved that to financial services and automobile. And the clear big part of the strategy is focus on mid and small caps, because that is what has given alpha for the fund. And we have generated significant alpha in the last couple of years in the mid and small cap strategy. Our key, as I said, our key active weights are financial services, telecom, healthcare, real estate, and automobile. And we are underweight on consumer, IT, and metals. Next one. Uh, so since this fund has a 20% exposure to fixed income, so in terms of the fixed income, we largely follow an accrual strategy. We do take tactical calls on duration, but not very aggressive calls. So out of the 20-25% or duration, tactical calls are generally limited to 3-4%. Again, there's a huge emphasis on asset quality here, because the reason being that we are, as it is, taking a bigger risk on the equity part, and even within the equity, we are taking a 30% allocation towards mid and small cap. So it's quite imperative that the debt part, we focus a lot on asset quality. So a large part of our allocation is towards AAA or AA rated stocks or sovereign securities. We have reduced the average maturity to around 5 years. It used to be about 6.5, 7 years a year back, and we aim to reduce it further in the current interest rate scenario. And we have also taken some exposure in floating rate bonds, and depending on where the rates are, we have not taken a very aggressive call on duration. But in the past, I remember in 2016, or even in the past, wherever we have taken a call on duration, we have been able to realize significant alpha. So I think we just want to ensure that we keep the risk profile of the fund within limits, and that is best done to ensure by ensuring that the debt part is kind of operated. within the lower ends of the risk which a particular debt fund would have. Next one. So in terms of a composition, I think a large part is government securities or AAA. It's almost 75-80% of the portfolio. Again, some of these AA minus are some of the legacy assets which we acquired about 3 years back, and we are quite hopeful of kind of recovering that. The D1 is fairly it's kind of written off, and anything which comes out is actually positive. Our average maturity is around 5.25 years, and the YTM is around 5.94%. And if you can see from the top holdings, I think these are fairly liquid as well as very strong companies that we have invested on the debt side. So just I think if you look at the longer term track record, I think we have done very well on 1 year. I mean, while on a 3 year, we are closer to the benchmark, and same with 5 years. But I would just, give your attention to one figure there. Since inception return since 95 is 14.8%, which I'm sure all of you would won't dispute that this is a very reasonable figure or a very good figure to have since inception for a 25-year time frame. I think that's been our focus, and we have had some hiccups in the past in terms of both on the debt and the equity side, but with this kind of a consistent strategy, our aim is to outperform the benchmark consistently, as well as maintain the risk profile of the fund over the coming years. So in short, I think just to give a brief summary of it, I think hybrid category is probably a very kind of a, I would say, any investor needs to have an asset allocation over a period of time, because as you age, as you go to 40 or 50 years or 60 years, you can't have the same asset because your risk profile changes. And the advantage which essentially these hybrid funds or an asset allocation funds typically would give you is the fact that there is an automatic asset allocation which happens, and we also need to recognize the fact that they are different performing cycles which I showed you. So these funds are very ideal, once you cross a 30-40 year. And my belief is that you should have a certain amount of your portfolios dedicated towards these hybrid funds, depending on your risk profile. Say, for example, if you're 30 years, you can have higher share of UTI hybrid fund. If you're 50 years, you could have a higher share of the UTI regular savings fund, which is far lower on the risk profile. But I think this should be an essential part of your portfolio. So with this, I'm through with my presentation, and I'll be happy to take any questions either on the fund or on the category.
Thank you, Srivatsa. It was a nice presentation, and I'm sure all our viewers would have got good insights on the hybrid funds. There are a few pointers which I thought we can discuss for the benefit of our viewers. So the first one being a lot of our investors are first time equity investors. So anybody who wants to look at equity investment, which are the one or two hybrid categories which a first time investor can look for investing?
Yeah, I would say one can actually start with a UTI regular savings or the conservative asset allocation that we call, because that is essentially the equity is capped at 25, and that kind of gives you a return which is slightly higher than a debt. But again, the risk profile is far superior than a pure equity fund. So what typically happens is, even I also get a lot of experiences of my friends or well-wishers, who take advice from me, is that a first-time investor into equity typically gets unnerved, when he sees the markets falling 10% or his fund values falling 7-8%, as probably what has happened year to date. Some of the funds have fallen 5-6%, including the core equity fund which I manage. And they typically tend to get unnerved because they would have probably been investing in some form of debt, or they probably, one, of course, the one part which I've seen is they do know about it, but when the reality hits it, they kind of get panicky. So I think this fund would be very ideal, or this category would be very ideal for anybody who is doing a first time investment into equity. Especially, I would say somebody who is into 30s or 40s, and who's historically invested in fixed deposits and wants to try out FDs for the first time. I think this is a very ideal kind of a fund to look at.
Another very very talked about category now is a balance advantage category, and a lot of people now recommend, even for this year, a lot of experts recommend that you should look at a balance advantage fund. So if you can also throw some light on balanced advantage and what is the difference between a balanced advantage and a hybrid, aggressive hybrid.
Yeah, sure. See, we don't have a product in that category, but we have a similar product called the multi-asset fund. The only difference being that they have certain investments in gold. But leave aside that, it's very similar to a balanced advantage. Now, the main thing in a balanced advantage is to lower the volatility further. So what typically happens is that generally, while in hybrid your equity is capped at 75. So if you look at the entire aggressive hybrid category, most players are between 70 and 75, most of the funds generally. Now once you go to the balanced advantage, I think the aim is to even lower the volatility further. So your equity would range between 35 to 75 depending on your assessment as what are the valuations of the equity market. uh, Again, the equity investment is kept at 65% because otherwise you would lose the benefit of the equity taxation. So equity. So what happens is generally, if I decide, say my equity allocation is 45%, then generally 25% of my investments happens in futures or in derivatives to help us qualify for that 65. But I'll tell you, a bigger challenge in this fund is always to, we all work on a model. So even for example, the multi-asset fund, also, so all the fund houses or all the funds, they work on a certain model. And I think in the last probably couple of years, it's been quite challenging to kind of time the markets by any kind of a model. But then I would say that this is also a category which is kind of emerging in a very big way. And we also have a product there. The only difference being that we have a 10% allocation to gold. And this is also very ideal. I would say after the conservative fund, I would rate this as a second option for an investor to invest.
And the third one being the aggressive hybrid, maybe.
Yeah, aggressive. Then the other part is that we have solution oriented funds such as a retirement or a children. I think those are also quite ideal funds. But yes, I mean, for example, you have a child, you want to plan for his education after 18. Some of these children funds are very ideal for that.
Okay. The another point that we wanted to take your views, and some of our clients also want to look at is arbitrage funds. Uh, are they safe, and what is the time horizon that people should look at if they want to look at arbitrage as a category?
See, if you look at arbitrage from a safety point of view, yes, it works on a basic principle that your futures always trades at some kind of a premium to the spot price. So you try to kind of capture the difference between both. So the risk is kind of, I mean, we have a very efficient market in terms of operation. So there is no kind of failure which happens, or and we have been managing it for years. So the risk is more operational, if any, like you kind of forget to roll over, or I'm just highlighting the risk part, which is an extreme, it's a kind of a black swan event. I don't think it's ever kind of happened. But yes, sometimes what happens is in a weak market, you may not get many arbitrage ideas. So your return profile maybe, I mean, if one works with a standard 4% or 4.5%, there could be times it could be lower, it could be 3% or 2.5%. We, however, also try to balance it out by having a kind of a decent debt allocation, because while it's an equity fund, we generally just go by 65% equity, because these days I think there are too many arbitrage funds, and anywhere to get a 4.5 upwards of it, it's a very big challenge. And so we typically try to do it through equity, again investing in liquid assets. So the ultimate aim of this fund is to give a product, an equity oriented product similar to a liquid fund category. in terms of the risk as well as a return profile. And I think that's where this category has kind of succeeded in a very big way.
So we have one question again related to what you just spoke about in terms of long-term investment targeted, some goal kind of targeting. So it says, sir, I want to understand, should I look at hybrid for my retirement planning or should I look at from a medium-term investment? My retirement is close to 15 years. So with that horizon, should a normal hybrid he should look at or a solution-oriented product?
I would say a kind of a solution-oriented product is better. Something like a retirement product, which kind of offers an option of both debt and equity. So some of the retirement products offer initial 100% equity, and then you can gradually, probably after every 5 years, you can change it more towards asset allocation as well as pure debt. That would be kind ideal. And you could also have a kind of a suite of both equity as I said, see, there's no, I mean, if you look at an investor's kind of a portfolio, he should have exposure to various different types of classes or fund classes. I mean, it will be foolish to have 100% equity and foolish to have 100% debt. So an ideal one would be to have, say, a certain allocation towards pure debt, 15-20%, maybe a 30-40% towards pure equity, and maybe another 20-30% towards these kind of asset allocation, which kind of balances out the debt. And as you progress, probably, maybe upwards of, say, 50 years, a kind of a balanced advantage and in India, I think we don't have many pure asset allocation funds, which kind of go between debt and equity. These are essentially equity oriented funds. A balanced advantage kind of a fund would be quite ideal once you cross that 50 or 55 years.
Another interesting question, which I think everybody wants to know today, this is on crypto. I know it's not directly related to what we are talking, but it says, will we get crypto categorized as asset class, and will we get any mutual fund, who will invest into crypto? So
Well, I have to give a disclaimer. I have tried understanding crypto. I bought a couple of books, but maybe I'm old, so I'm upwards of 45, so I'm not able to understand or appreciate. I mean, I can only relate to the latest statement of the governor that it is even worse than a tulip, because at least in the tulip crisis there was a tulip, there was some asset. So these are not backed by any assets, and again, you may call me an old age investor, but any investment which is not backed by any asset is something which I have a very big discomfort to. So, I mean, I'm sure there will be funds investing in it. It may emerge as a big asset class, but honestly, I'm not able to appreciate this asset class which doesn't have any assets backing it.
okay. At the same time, if somebody has to invest maybe a small portion, very small portion, just for a trial purpose, people can do it, but it cannot right now form large part of your wealth as of
See,
now. It's very
one is not sure of the legality, or one is not sure. I mean, if you look at the Indian savings cycle over the last 30-40 years, you have had these. I mean, I'm not comparing crypto with those products. I mean, if you recollect 25 years back, there were a lot of these plantation based funds, or
Right.
they said that you invest this, we'll plant a teak, and after 25 years, you will get 10 lakhs or whatever. I'm not comparing this with that, but you will have these kind of products which typically do tend to come. It'll also create a frenzy, because once an asset class creates a certain return, it attracts a lot of investors. Ultimately, the real test of whether it creates longer term value is backed by the asset that it I mean, see, for example, if I invest in gold, there is an asset backing it. If I invest in a gold ETF, there is an asset backing it. I may make negative returns on it, but there is a certain asset backing, and this asset has a cycle of 100-year cycle in which I can evaluate. But unfortunately, this has no cycle. This has no asset backing. I mean, yes, you can invest, make money, but again, that's not something that I would recommend.
I think, Srivatsa, we are done with our Q&A as well. So thanks a lot for sharing your views and doing this webinar for our clients. And I'm sure it would have been very helpful for our clients. So thanks a lot for doing this today with us.
Yeah, thank you, Gaurav. My pleasure.
And I would also like to thank all our viewers. Please do explore our Moneyfy app, and you can download the Moneyfy app both from Play Store and App Store. And also do subscribe to our YouTube channel for more updates on investment and more such sessions. Thanks, everyone. Thanks, Mr.
Thank you.
Srivatsa. Thank you.
Thank you.
Bye.